This video is for educational and entertainment use only. The views in this video do not necessarily represent the views or life of Marlon Dixon.
Welcome back to Duffle LO, to sit down, you guys. And I told you guys I had to stop my videos from yesterday. So today is actually a new day. So don't get mad at me wearing the same thing because I do that sometimes. But no, on a serious note, I told you guys about how they setting you guys up with these retirement accounts. Like I said, you put the money into the retirement account. They're not bad like when you really think about it, but in reality, it's an old concept. And now that I understand that it's an old concept, I can see the good in it, but I also can see the bad in it because I'm 33 right now. So if I can't withdraw any of my money out of this account, I'm 59 and a half. What are they going to be doing with my money for the next 26 years? That's a long time to get somebody your money in hopes that you're going to get it back. So let's get into this because I'm going to explain to y'all why I said it's an interesting situation. So go ahead, like, share, subscribe. Make sure y'all comment down below. And this is why I said it's crazy. Because if the market is up and they telling you to make sure that you max out your Roth IRA and all these accounts is healthy and all this stuff, if these accounts is healthy, why is they saying the dollar is falling and the markets are in a wonderland over inflation and Fed? The reason they're saying it's overinflated. Why? Because the Fed kept printing all this money, giving everybody all the free money, all that people was putting into the market, making the market pump up. When in reality, the market, it has to burst. It has to burst. But if it don't burst, guess what's going to happen before it bursts? The same thing what happened in the last crash. The people at the top going to take all their money out, which is going to cause it to dip. That's why it's gonna go down. Then once everybody see it starting to go down like that, everybody gonna start going to take their money out, which is gonna cause it to go down even further. Like, this is why I want you guys to start getting into investing and understanding some of this stuff. And like I said, I talk to people offline about that because this is stuff what I put out for free just to get people, brain juices flowing and everything. But the investment stuff, I do that offline. If you guys want some consulting and all that stuff, like, just hit me up on the email and we can talk. As you can see, January 14th, which was 2 days ago. So it would have been a day ago if I would have recorded this yesterday, but let's get into it. Shout out William Watts, investor pricing and scenario that is stuff of fairy tale strategist warns. Keyword warns. So now let's get into it. The US dollar is offering up an early 2022 head scratcher. Why does the currency keep falling even as traders aggressively pencil in as many as 4 interest rate increases by the Federal Reserve this year as it scrambles to rein in red hot inflation? To rein in red hot inflation. So if they gonna pencil in as much as 4 interest rate increases, so if they gonna increase the interest rate 4 times, why is people study trading? Like, why are they keep trading and keep putting their money in the market, knowing that once the increase happens, that's gonna make the situation go down? Plus the dollar is failing. But people not understanding investing. A lot of this investing stuff was originally for accredited investors and people that have been in the stock market for years, like, the big hedge funds and all that stuff. But now a lot of these apps that came out and we have a lot of retail investors that don't understand 100% what the investment field and spectrum and world is really about. So they throwing their money in there in the hopes of, man, AMC went up, Dogecoin went up, I'm gonna be rich, I'm gonna be a millionaire, they made all that type of stuff. In reality, they not understand. They just holding up something that's already wobbly, that's getting ready to fall. So they're gonna end up with nothing at the end of the day, which is sad. So let's go. The ICE US dollar index DXY plus 0.4%. A measure of the currency against a basket of 6 major rivals was down 0.1% on Thursday at 94.81, hitting a 2-month low. The index is off 1% so far this week, leaving it with a loss of 1.2% since the start of the new year. So the dollar already down 1.2%. So 1.2% meaning, let's say you start off with one actual dollar, you actually have 98.8% now of your dollar. Well, you'll have 98.8 cents. That's what you'll have. A more aggressive tightening of monetary policy from a more hawkish central bank will usually be expected to support a currency. The reaction may make more sense, however, if one looks at how little interest rates are expected to ultimately rise once the Fed begins the rate hike cycle, said Kit Jux, global macro strategist at Societe Generale. Listen, when they do the first rate hike, everybody is going to be, and they telling you it's going to be 4 of them in this 1 year. The reason why they doing this rate hike is a deeper situation than everybody is really understanding. And if you do your research into the rate hike, you really get to understand what's going to get ready to happen. Because you got to see what happened in 2008 when the Lehman Brothers failed. Economy went down. And when the economy went down, a lot of the rich got richer. Why? Because they was able to buy all these properties and all these stocks and everything at pennies on the dollar. That's what this stuff is about. It's about getting rich. He noted that while traders have moved quickly to price in 4 rates increases this year, they still look for the Fed funds rate, currently in the range of 0 to 0.25% to top out at no higher than 2%. If you go from 0 to 2%, that's a big jump. Even 0.25 to 2% is still a 1.75% jump. That's not realistic, but it may explain the recent performance not only of the dollar, but other assets as well. Markets are in a wonderland, he said in the Thursday notice. Now think about that word. Why would you use the word wonderland? This is my equivalent of what I call in my videos, la la land. So because people are in la la land, I mean, they're not understanding what's going on. They're not caring about what's going on. They're not knowing what's coming or any of that. Everybody's just having fun. And the wonderland, what really makes it even more interesting is snow outside. That's why I got on this blue, because I'm going to tell you guys like this. You guys going to need some relief, because when the market crashes and you don't know what's going to happen, you're going to be blue. Because the investors going to eat you. U.S. stock market investors are cheered by the prospect of a terminal rate of 2% and ignoring a more hawkish Fed because the prospect of faster rate hikes reflects hope that the worst of the COVID pandemic, the Fed funds rate topping out at 2% is Goldilocks scenario. To the extreme, Juck said, and is reflected in a reaction Wednesday to a 7% year-over-year rise in the December Consumer Price Index, a nearly 40-year high. We saw the S&P 500 SPX 0.08% climb back within 2% of its all-time high, and the SIBO Volatility Index negative 5.51% fall back hard. The VIX, a measure of expected S&P 500 volatility, spiked to a more than 4-week high above 23 earlier this week before sliding back below its long-term average around 19. Stocks lost ground Thursday as a bounce back tech stocks lost steam, leaving the NASDAQ composite 0.59% down 2.5%, while the S&P 500 lost 1.4% and the Dow Jones Industrial Average lost 0.56% share. Now look at the dollar. I just want to let you guys take time to look at this. Let's see where it started at. Dollar was all the way down in 2021 to 92. And you see, it went up. It got all the way up to 96.88. See, that's November 24th. But look what happened. Where's December 31st? Right here. Let's say December 31st right here. 95.97. But look at what it's doing. It's tumbling all the way down. Went to 94.79. What you guys got to understand, this is why I told you. You have to look at the other video when I said that Americans will be forced to deplete their savings in 2022. This is what this is talking about. This is what this chart entails. If you have to pay for your livelihood, your rent, your mortgage, your car note, all this stuff, but you have your money in the market and you don't have no money, or you're not making enough money to cover your bills, you're going to have to withdraw that money out of the market. That's going to cause the market to dip. You're going to have to withdraw that money from your savings, which means you're going to need, if you can't afford it and you need to draw on your savings, you don't have enough money. People are being flashy and they're not understanding what's coming. The CPI data make headlines, but if the race market doesn't think they put pressure on the Fed to tighten more as opposed to faster, tighten more as opposed to faster, and the equity market doesn't think that they're a threat to the economy, then why should the FX market not include that other cheaper currencies can benefit as the post-pandemic recovery takes hold around the world, he asked. The problem, Jack said, is that a scenario in which the Fed can return the U.S. economy to equilibrium with the full employment and modest inflation just by taking rates back to 2% is the stuff of fairy tales, not the real world. Why do people think when they raise the rate that that's going to take it back to normal? It's not going to take it back to normal. What it means is when they raise the rates, it makes it harder for those people that are already accredited investors that can borrow money at 0%, which means they got all this free money. Now it's just going to make them be able to not be able to borrow money at 0%. They're going to get it at 2% because people like me and you, we don't have an interest rate of 0%. The best interest rate you probably get is probably 2.3% or 3.5% or something. You're not getting 0%. That's for the insiders. So it's a fairy tale world, like he's saying, that y'all think that once they raise the rates to 2%, everything is going to be back to no, that's not what's going to happen. Indeed, the terminal rate below 2% is increasingly at odds with with what policymakers are signaling they would like to see, said Jonas Gosterman, senior market economist at Capital Economics, in a Thursday note. Fed Chairman Jerome Powell earlier this week indicated that policymakers want to get policy to a neutral or even tight setting, which suggests a policy rate above 2.5%. Gosterman said, and suggestions that quantitative tightening. See, look, now quantitative easing, now they doing quantitative tightening. Quantitative easing, quantitative tightening. You have to look into these terms. As the Fed shrink its balance sheet, will begin sooner and proceed faster than it is previous tightening cycle is another hint toward a higher terminal rate, he said. So everybody thinking that 2%, 2.5% is what they aiming at. No, they gonna aim way higher than that. And if the people, listen to this is how money is created. Somebody that's already an accredited investor go to the bank and borrow money from the bank. That's how money is created. They borrow this money at 0%. If the interest rate go to 7%, and they say, you know what, I don't even really want to borrow that much money, then it won't be that much money in the economy. Yeah, you get it. The reason why money is created because investors went and borrowed the money and then they have to pay it back. So I borrow 100 million, I put 100 million into the economy, but I ain't got to pay nothing back but this 100 million. I go borrow 100 million and I got to pay back 7 million. Man, I might not want to do that. So I ain't gonna borrow no money, which means there is no more money in the economy that's newly being put in there. That's when everything gonna start going haywire. And when they saying quantitative easing is they trying to ease the pressure, that's why they was giving out the money. Now when they saying that they finna shrink their balance sheet, rather than them just saying, we finna sell some of the assets on our balance sheet, they say we're gonna shrink our balance sheet, which basically means the same thing. They're going to sell off a lot of their assets. When they sell off a lot of their assets, that's going to make the market go down once again. So all this is set for the economy to go down and the market to go down. It's all literally set up for it to do it. If the Fed succeeds in an apparent intention to tighten the policy stance more broadly, we think that will lead to a stronger dollar. Keyword, they think. They ain't saying we know that it's gonna have a strong dollar. Oh, they saying that they think. So y'all gotta use y'all brain and really think this stuff through. That this is why I try to tell people not to spend all their money. I'm not saying just save your money, and I'm not saying like I've been into this investing stuff for just a little bit over a year, but I've been understanding and learning so much, and I'm trying to explain to you guys like when you just go willy-nilly spend your money and you don't save nothing or you don't invest none of it, your money fails. Now, this is going to scare a lot of people from investing because when they say, I just put my money in the market and now my $100 just turned to $10. Oh, I ain't messing with the market no more. No, you don't understand market manipulation. You don't understand that this manipulation of the market been going on for umpteen years. So this is the same thing. It happened in 2008 when all of these situations, you see what it said in the video? Go back to the video, 107%. All the pensions was up above 100%. It was at 107% full. Now they saying, oh, the pensions is ready for the ripening again. They're looking really healthy. They're 100%. They telling each other, bro, we can get ready and take their pensions again. That's literally what they telling each other. Y'all got to understand this lingo. That's why I try to bring it to y'all. And that's why I take my time and tell y'all, like, I love y'all. That's why I'm telling y'all this. Hopefully y'all love me. But that's all I got to say for this video. So prosper through adversity. Don't underestimate family, friends, lovers, enemies. Look objectively. No matter what city, state, or country is in, every hood is the same. If nobody told you that they love you today, I'm going to tell you that I love you now because I love you guys. That's why I bring you guys this information, because I want you guys to become aware. The reason I want you guys to become aware, because when you're aware of what's going on, you make better decisions. So I want you guys to make better decisions because I want the country to actually grow. I don't want the country to be stagnant. I want it to grow. So the more people become aware of what's going on and they able to actually intelligently make decisions, the better we'll be off as a country. So that's all I gotta say for this video. Like, share, subscribe. Make sure you guys comment below. Hit me on the email if you want anything investment about that, because this is not investment advice. I'm just telling you guys what I understand, as I understand, it's my opinion, and I'm telling you guys what I do. So just understand that.
This video is for educational and entertainment use only. The views in this video do not necessarily represent the views or life of Marlon Dixon.